Good evening, everyone. On behalf of Axis Bank, Axis AMC, and Price Waterhouse, I, Naval Kagalwala, Head of Wealth Management at Axis Bank, extend a warm welcome to each of you. Thank you for taking time out today evening to join us in this discussion where we try to decode and discuss some of the key announcements and implications from the Union Budget 2022 announcements made yesterday by our Honorable Finance Minister. As many of you would have heard, the Finance Minister began the budget speech with a long-term vision for India at 100 and how the various policy initiatives and developments over the next 25 years can help our country become one of the largest economic superpower. However, in addition to the long-term vision, there were also various elements from a shorter-term and immediate need perspective that can help businesses come out of the challenging 2-year period that we have seen post the COVID. As is the case always, the various discussions and reports which have come out so far showcase two completely different sides of the budget. On the one hand, we have the industry veterans, business leaders, and investment gurus who have hailed this as one of the best budget ever. The long-term vision, continuity of the policy initiatives, and the high focus on growth, in spite of this being a key election year, has everyone cheered up. Barring a few minutes of fall that we saw yesterday, the stock market has also echoed these sentiments. However, on the other hand, there are a few concerns which have also been highlighted. One of them being the high borrowing by the government, which saw the yields on government securities inching up by about 13 to 45 basis points yesterday for the 2 to 10 year paper, and the high focus on growth, which could lead to inflationary trends. Additionally, people in general were disappointed that there was nothing in the budget for them. No reduction in taxes, no increase in investment limits for tax-saving products, and more. While there are expectations that the manufacturing push will create an additional 6 million jobs over the next 5 years, guess the people expect and prefer a bird in hand rather than two in the bush. With this quick background, I now proceed to introduce to you the three speakers we have today. Starting the discussion today, we have Mr. Vishal Khanna, Associate Partner at Price Waterhouse in the Tax and Regulatory Financial Services practice. He has over 20 years of experience in the Indian corporate tax space, including 10 years with the India operations of a leading US bank as Executive Director in the corporate tax team. He also has extensive consulting experience in income tax and Indian regulatory issues while servicing Indian and foreign clients. Vishal is a commerce graduate from the Banaras Hindu University and is a member of the Institute of Chartered Accountants of India. Taking over from him will be Mr. Jinesh Gopani, Head of Equity at Axis AMC. He joined Axis AMC in 2009 as an equity fund manager and worked his way up to Head of Equity in 2016. He currently manages the flagship Axis Long-Term Equity Fund in addition to a few others. Jinesh has a master's degree in finance from the University of Mumbai. And finally, we have Mr. R. Shiva Kumar, Head of Fixed Income at Axis AMC. Shiva, as he is more popularly called, also has over 2 decades of experience in the Indian asset management industry. He was part of the startup team at Axis AMC in 2009, looking after the products and portfolio management services. He was responsible for leading the launch of Axis Signature and the award-winning hybrid funds. In September 2010, he was promoted to head the fixed income desk. He is responsible for the overall investment strategy, performance, and risk management across the fixed income investments. Shiva is a Bachelor of Technology from IIT Madras and has also done his post-graduation from IIM Ahmedabad. With this quick few words, I now hand over the floor to Mr. Vishal Khanna.
Thank you, Naval, and good evening, good morning to everyone on the call, on the webcast today. I'll be taking up the tax related changes that were announced by the Honorable Finance Minister yesterday. Of course, like Naval said, there was a lot of discussion, probably some expectations not met around a lot of changes that were expected on the individual tax front. In the next few minutes, I have some slides that I'll be taking you through to describe what are the key changes that have been brought in yesterday as impacting individual taxpayers. There are certain procedural aspects, certain procedural changes, and I'm not going into details of all of that. But perhaps the more talked about changes, the more policy level changes is what we can spend some time discussing. So yeah, I've just put on the slide here. First of all, let me give you a flavor of the key policy announcements or the policy direction which the finance minister tabled yesterday. So four key pillars here: stability, predictability and certainty, rationalization, and building trust. Um, I would think stability because no significant tax rate changes in spite of the pandemic and all of that. There's no big change, upward revision, etc., in the tax rate. Certainty because of clarifying taxation of cryptocurrencies and NFTs. They are now defined as virtual digital assets for tax purposes. Rationalization of surcharge in certain key areas, and there was a bit of a disconnect there earlier, which has been corrected, I would think. And also, new schemes of updating your tax returns, avoiding repetitive appeals, and kind of taking off the load or the approach of high litigation in tax disputes. So with those four pillars, let's get into two or three key aspects that have been announced yesterday. The first one, and this is perhaps the most talked of change that is now proposed to be introduced. This will be effective 1st April 2022, so financial year 22-23. Taxation of virtual digital assets, more commonly referred to as cryptocurrencies in the day-to-day parlance, but the government has actually introduced a definition of what is a virtual digital asset, and that includes non-fungible tokens and any asset that is generated through cryptographic means. There is also a residuary clause there to say that the government could later on notify any other assets, any other digital assets which it deems fit as virtual digital assets, and which would then be subject to the tax regime that has been introduced yesterday. So the key impact, the key point here is when you trade in a virtual digital asset, which, like I said, is either a cryptocurrency or an NFT today broadly, the gains that are made on that trading is subject to, or is proposed to be subjected to, a rate of tax of 30%. Now, from an individual's perspective, this is the highest rate of tax that one gets to. But 30% is the base rate. So what happens is, depending on your income threshold, there is a surcharge and a cess that is applied to this base rate. And if you apply the maximum rate of surcharge that can potentially apply to an individual today, which is 37%, the effective tax rate on virtual digital assets could go as high as 42.7%. So in any economic decision, in any trading decision, in any gains that one makes, one has to, of course, take out the tax cost, that needs to pay to the government, and the residual tax cost or the residual advantage here from trading a digital asset would then be approximately 57 to 58% of the total gains that are made. The important point to note is that other than the cost of acquisition of the digital asset, no other deductions are allowed in computing your net income, which is subject to this 30% rate of tax. So, for example, when you trade, say, equity shares, you would get a deduction for brokerage, you'd get a deduction for stamp duty and the incidentals that you incur in buying and selling the equity shares. But in digital assets, none of those costs are allowed at a deduction. Also, when you incur a loss, typically in case of other assets, you would have losses that could be set off against other income. So short-term losses, long-term losses, business losses, etc., house property losses. But any loss on a digital asset is not allowed to be set off at all or be carried forward. So if the net result of all your trading in digital assets is a loss, that loss is actually a loss, and it's not allowed to be set off against any other income. Uh, in order to ensure appropriate compliance, what has been added is that the virtual digital asset gains would be subject to a TDS of 1%. So the person who's making a payment of the consideration is liable to deduct that tax. Now, in a exchange trading, in a screen-based anonymous type exchange traded scenario, how this TDS would operate and how the person making the payment would deduct or be eligible to deduct, pay, and then record and do all of the resulting compliances of TDS is unknown today. So I think there might be some operational disconnect and how that exactly needs to be complied with. But nonetheless, you have a withholding tax provision that's been brought in for the virtual digital asset. Uh, I'll move on to the next one, which is again a significant change for individuals or anyone trading or investing in the capital markets, equities, debt, any of it. And that change relates to bonus stripping. What I mean by bonus stripping, and I'll just take a moment to elaborate this. The basic concept for when you receive bonus, say shares, in when you're holding shares and you receive a bonus is declared by the company and you receive bonus shares. The basic concept from a tax perspective is that your cost of acquisition of the bonus shares is nil. So when I sell that entire lot of shares that I'm holding, for the lot that I've purchased in the market or perhaps in an IPO, there is a cost that I've incurred. That cost is allowed as a deduction, and I would get a gain or a loss. But in case of bonus shares, the cost is taken as zero. So anything that you earn from sale of a bonus share is the gain that you have to pay taxes on. I've put here two examples. If you look at the first table, which is the current tax regime, up until now, if you had holdings of a equity share, bonus was allotted. And for the sake of this example, we've assumed that the bonus is 1:1. So bonus is allotted. Consequently, the sale price typically dips a little bit. And we've taken that it dips exactly by half in this case for the sake of easier understanding. So when I sell the original lot of shares that were purchased for 30,000 and I sell it for 15,000, I incur a loss of 15,000. That loss is today eligible for being set off against other capital gains that I have incurred. If I don't have any other capital gains, I can carry forward that loss. So there is an opportunity to have that loss, and if I have other taxable gains, to avoid or not pay taxes on that by setting off these loss that I've incurred. Now, what has been proposed is that in exactly the same situation where I have gains that, I have shares that I've bought from the market, and I'm selling that post a bonus issue, I incur a loss. Because I'm continuing to hold the bonus shares, that loss would not be allowed as a set off or carry forward. And what would happen is that loss gets recharacterized as cost of the bonus shares. And as in when I sell the bonus shares, that is when that loss would be available to me. Effectively, what all this means is that the loss that I've incurred on sale of the original shares would be not available to me immediately, but would be back-ended or available to me as and when I sell the bonus shares. There is a timeline to be noted here. So if the acquisition of shares is within 3 months prior to the record date, and the sale of shares is within 9 months after the record date, exactly in that situation, the bonus stripping triggers and not otherwise. So the point to be kept in mind is that if I've acquired shares and I'm selling it within 9 months of a record date, then I need to be aware that the losses, if any, that are generated may not be immediately available for set off and may have to be recharacterized as cost of the bonus shares and taken accordingly. Now, this bonus stripping provision was up until now there for mutual fund units. The budget has proposed to extend this to all securities, including shares. There are certain nuances that come up in cases where other securities are issued, for example, and it's not always a bonus share. Suppose there's a NCD that is issued as a bonus NCD. How does this whole provision play out in those scenarios? Is something that one needs to look at more minutely before taking tax positions. Uh, the third important point to highlight, and it's important from an individual perspective, and I think it's a welcome move. The government has proposed that any payments received by an individual for treatment of the pandemic related illnesses for self or family from the employer or from any other person would not be subject to tax. Any sum received by a family member on the unfortunate demise of another family member on account of the pandemic related illnesses would also not be subject to tax for the recipient. Where such payment is received from a person who's not the employer, then there's a limit, there's a monetary cap of 1 million, a 10 lakh rupee cap. But other than that, there are no monetary limits that have been put on these receipts. So I think a significant welcome move there and need of the hour in that sense. The next part is a little procedural, and it's around updated tax returns. So if there are taxpayers who have missed out certain incomes that were to be reported within their tax return, and you later on realize that we missed out certain income, you have a time limit or an extended time limit now under which you can file an updated tax return. There is, of course, an additional tax to be paid plus interest. So the tax goes up by 25%. So suppose there's 100 of income that has been missed out, I would have to pay the normal tax plus plus interest thereon, and 25% of that amount would have to be paid, provided I file the updated return within 3 to 12 months. Where such updated returns is filed after 12 months, but before 36 months, the additional tax goes up from 25 to 50%. Again, it's like introducing an amnesty sort of a scheme within the provisions of the tax law. So if there's a genuine miss out or otherwise of any income that is supposed to be disclosed, that can be rectified later. This is the last slide that I have, and again, 2 or 3 key changes. A lot of individuals today have startups or ambitions of a startup, and there is a tax regime that gives you a 3-year holiday on startups. There was a condition that the startup should have commenced operations by 31st March 22. That has now been extended by a year, and it's that date has been extended to 31st March 2023. The second one here on this slide is again a significant change. The maximum surcharge on transfer of equity shares today is capped at 15%. For all other assets, the surcharge could be higher. So like we discussed earlier, depending on income thresholds, that surcharge could be 25% or 37%. Now, the tax law has been amended to say that on any long-term capital asset that you hold for 12 months in case of securities or 24 months in case of any other assets, the surcharge on those gains are capped at 15 and would not go up to the higher levels of 25, 37%. So that's the rationalization measure that has been brought in. The last part, and again, probably important for individuals who are in business or profession and receive benefit in kind from, say, companies, could be pharma companies or any other companies to promote their products. Those benefits have been subject to a tax, a TDS of 10%. So the company paying the benefit to, say, a dealer would have to deduct a tax of 10% on such benefit. And consequently, the dealer would have to include that income in the tax return and subject it to the normal tax rate that the dealer is supposed to pay. Now, this benefit is not new. It's always been there. Companies would give out encouragement benefits to their dealers, etc. However, in this situation, it has been brought under check or under control or under the purview of taxes. And if there's a withholding or TDS that is applied, the person receiving the benefit is now, in one sense, obligated to include it in the income and file a tax return accordingly. Now, those are the 4 or 5 points I wanted to talk about, which are, I think, key and important from an individual perspective. I won't stand between the audience and the market experts now, so I'll hand it over to Jinesh to take this discussion forward. Thank you.
Thank you, Vishal. Thank you, Naval, for having us here. And good evening, friends. From the equity market point of view, I would say one thing is no harm done. So just taking from what Vishal said on the stability side, clearly no negative surprises is good for equity markets because equity markets don't like significant surprises, more on the negative side. So no harm done, I would say it's good. The focus of the government clearly shows from push on growth, which is again good from corporate earnings point of view. So the GDP growth of 8% is what being talked about. And that is a significant push, I would say, especially for the economy, which has just come out of COVID. So again, that bodes well for the corporate earnings. And as all we know, markets are slaves to corporate earnings. And as corporate earnings starts moving up, I think markets will also get re-rated. However, taking into account some of the volatility which might be around. Other good thing I would say is no socialist or populist measures undertaken. In fact, the subsidy bill is down by 25-27%, which is again a good sign, I think, in terms of, as Vishal said, on accountability and transparency. So no major populist measure is again bodes well from the stock market investors' point of view, especially from the foreign inflows, what we are looking at. Some of the legs of spending, which is affordable housing and infrastructure, again bodes well from the continuity point of view. The affordable housing spend is around up 75% to 48,000 crores, and capex spend, if you take into account off balance sheet and on balance sheet, then it is up 10% than what it was announced, around 25%. But still, it is good given the state of affairs, given the constraint what with the government is operating. So net, I would say no negative surprise is positive. Now everything will come down to basics of earnings growth, and as you see more corporate earnings growing over a period of time, you will see markets reacting positively for that. So net, I would say it's a good budget, decent budget, I would say. And although there are some concerns around inflation, which Shiva can touch upon, but 8% GDP growth is what I would really be looking at. If that is really in making, and we have more 7 to 8% GDP growth for next 2-3 years, then I think we are in for a good momentum in the corporate earnings. This is it from my side, Naval. Happy to give it to Shiva. Thanks.
Thanks, Jinesh. Good afternoon, good evening to everybody, and thanks for joining this call. Vishal and Jinesh have already set the context to a large extent. I'll just take a few minutes and talk about the impact on macro and on the interest rate scenario and fixed income markets. The key thing, I think, is the fact that they've not been done much in terms of rocking the boat. It's more of a BAU budget. But the markets, at least the bond markets in some sense, expected a little bit more. Firstly, the fiscal deficit at 6.4%, significantly higher than what the bond markets were hoping for. In some sense, the market expectation was closer to the 6% mark, and therefore a bit of a disappointment. A higher fiscal deficit means higher borrowings by the government, and therefore more pressure on liquidity and rates. So that's the first impact that we saw from the markets. The second is there was wide expectation that the government would take some steps to add India to global bond indices. Over the past several years, the government has made announcements in budgets and otherwise that there will be steps taken to ensure that India gets added to the global bond fraternity through emerging market indices. And not least because this could open a large pool of new investors into the bond markets. This was completely left out. We are talking about potential $25 billion inflow into Indian bond markets being switched off. This is again widely anticipated. I would say from a bond market perspective, these are the two things which caused markets to sell off very aggressively yesterday and to some extent today. First, the much wider fiscal deficit and therefore much higher borrowing. And second, the lack of any steps to get India included into global bond indices. Not much else really in terms of positives or negative really, and which is all good. A few small things which of course have an impact, like for example, the increase in prices of petrol. Obviously that can have some inflation impact, but on the whole, not so bad. Bond yields rose very, very sharply. They've risen by 15-20 basis points. What's really interesting is this has happened more or less across the board, whether you look at a 1-year paper, 3-year paper, 5, 10, or 30. Yields across the space have risen by 10-15 basis points or more. I can understand from a fiscal deficit perspective that long bonds yields will rise because, well, the government tends to borrow longer dated securities. So therefore, there will be more pressure for longer dated securities, interest on longer dated securities to rise. But the fact that short-term rates have also risen really suggests that the market is looking one step beyond what this budget said. Next week, we have an RBI monetary policy meeting. The fact that the government is going for a higher expenditure path essentially means that the government is focused on getting growth back on track. As both speakers before me have said, in some sense, and Jinesh particularly spoke, growth is definitely the focus of this budget. Post the pandemic start 2 years ago, we've seen really difficult environment for macroeconomic growth. We saw the trough in 2021, and of course, bounce back in 21-22. But realistically, the level of GDP, level of private consumption is just a little bit higher than it was back in 2019-20, which itself was not a great growth year, by the way. So, in effect, 2 or 3 years of really subpar growth. And the fact that the government is running a higher fiscal deficit is really to say that they are comfortable supporting the economy through higher government spending if necessary for another year. This is good news from a macro perspective. This is good news from a growth perspective. But what it also does is it complicates RBI's job. The RBI has been supporting the economy through its measures, through high liquidity and very low interest rates over the last 2 years. And the more that the government of India takes on the mantle of supporting growth, the less there would be a demand on RBI to do that. So in a sense, a higher fiscal deficit would mean that the RBI will have the flexibility to start raising rates and withdrawing liquidity faster than previously anticipated. So effectively, the market is now moving into a phase where they believe that the interest rate scenario even from the RBI will change. Over the last few months, we have seen globally central banks take the same route. We've seen the Fed and we've seen many other central banks start talking a bit hawkish. And the RBI also started withdrawing liquidity. Now the expectation is that the RBI will probably raise rates faster or to a greater extent than before. Because, well, like I said, the government is taking a higher share of the responsibility for getting growth back or growth into a stronger pace. So what does this really mean for bond markets? One is, of course, immediate reaction, where you've seen yields rise quite sharply. Is that the end of it? Well, probably not. We have, the new fiscal deficit and the new borrowing program starts on first week of April, and therefore it's very likely that as the first set of borrowings come into and hit the market, there might be still some pressure on rates. We may yet be in a situation where we have rising yields for the next few months. Like I said, also RBI may remain hawkish for quite some time, and therefore we could see rates continue to rise for several months from here on. So investment strategy in fixed income really has got taken into account the fact that yields are going to go up. And by the way, this has already started to happen. I mean, over the course of the last year and a half, we saw 10-year G-Sec yields at the bottom of maybe 570, and now they are at 690. So we've had a material sell-off in rates over the last year, which means that most of these risks have got priced in, but it's still some amount of pressure to come. And in a rising interest rate environment, we have to look at a couple of things. First, what part of the market can hold value, and in fact, what part of the market may still actually appreciate in value in a rising interest rate scenario. And so where can you hide? Where are opportunities to make money? I think there are several strategies. First and foremost, of course, the easy place where you make money when rates go up, which is to stay in very short duration assets, money market assets, floating rate assets, anything which appreciates or which can reprice higher in a rising interest rate cycle. Where can you protect yourself against a shock to the portfolio? There are several strategies which you can adopt. Roll downs, which basically means that where the duration of your investments keep dropping over time, and there are investment strategies which are like that, which definitely can help you hold value in a period of rising interest rates. Lastly, we also take a cue from the fact that the government is supporting macro in a strong way, and stronger macro means stronger corporate performance. And stronger corporate performance means corporate bonds, and especially the non-AAA space, likely to outperform. This has again been a theme for the last year and a half, where underlying corporate performance has been much stronger than what people anticipated. And I think that is likely to continue in the coming quarters as well. And that's therefore the credit space is again a space where we believe will be supported in the future. And so it's also useful that most credit funds have very short durations and therefore much less affected by rising interest rates during the same period of time. So there are, even though one looks at higher fiscal deficits and worry about it from a fixed income perspective, I think we should look at where we can actually invest and make money. I completely sympathize with the fact that the macroeconomy needs higher spending. We need growth. That's the need of the hour. We can talk from a bond market perspective and cry about higher fiscal deficits, but reality is that we do need to see growth come back, and that's the need of the hour. So prepare ourselves. I think we should prepare ourselves for higher interest rates. There are opportunities to make money in a rising interest rate scenario, and that's where I would say we should focus our attention. So rather than me rambling on and on for the next several minutes, I think opportunity we'll take some questions from all of you, and that will help focus the attention. So yeah, let's just take questions from everybody. Thanks.
Thank you so much. Thanks Vishal, thanks Jinesh, thanks Shiva for giving a quick overview on the tax provisions, the equity markets, as well as the fixed income markets. We already have a few questions coming in from the participants on the call today. So I'll just take up some of them which are relevant from the perspective of the discussion today, and I'll just direct them to either of you. So the first one, Vishal, I mean, as is the general expectation in any call like this, I mean, we have a question which asks saying that what is in the budget for me as a salaried person, for a middle class person, for me as a senior citizen or a retired person, and for NRIs. Now we know that there have been very few provisions or very little in this budget, but if there's anything that you can share on any of these specific queries.
So I would think from that perspective, stability and certainty are the hallmarks, for the budget overall and specifically for individual taxpayers. So no drastic changes, no additional coming in. I think in terms of rationalization of the surcharge for all the long-term gains on across asset classes, that is a very welcome move, because if I'm in a particular income threshold and trading assets, even though I've held it for a long term, I've been a good investor, the surcharge rates were really high, other than of course on listed equity. So I think that rationalization is a welcome move. And like I mentioned, it may not be the best or be what the investor would aspire for or desire, but at least some certainty towards the taxation of digital assets is a step, hopefully, in the right direction.
Sure. So what you're saying is that from a taxation perspective, the benefit that the investors can look forward to is a slight reduction in the tax that they will have to pay on the capital gains on any investments or any assets that they have, which is non-equity. So whether it is fixed income, whether it is real estate or any other assets, it will ultimately lead to a reduction in taxes.
That's absolutely correct.
So that's the direct benefit from an investor perspective.
Yeah.
Right. Jinesh, an obvious question for you is your expectation on the equity markets in the short, medium, and the long term. That is one part. If you can just take up, and then there's a follow-up question to that, which I can take once you answer this.
So long term is always bullish. Any 5-year cycle, if you see, markets have always given returns. So I think short term would be more dependent on the volatility around global markets. You have seen the in last month how the markets were volatile due to US yield moves and commensurate sell-off which we saw in India. Likewise, you will see volatility on the upside as well. I would recommend everyone to look at least for the 2 to 3 year view. Because near term can be volatile, things can be haywire for a certain period of time depending on how the oil prices move, how the yields move in the global world. But nevertheless, as I said, long term is always good. Corporate earnings hopefully should be good this year as well. And I think even government is looking at a good corporate tax growth rate. So if corporate earnings are good, ultimately flows will follow those companies, and we have to be in those companies remaining invested for a longer period of time.
Sure. Thanks, Jinesh. Jinesh, in continuation, I mean, 2 key events. One is, of course, let's say the outlook from the US Fed perspective on rising interest rates. And from an India perspective, the budget. I mean, both of these events are now largely behind us. I mean, we know what's in store. So how would you play, let's say, the equity markets in the short term? While we do understand, let's say, from a long-term perspective, you're bullish and everybody should look at equity investments from a long-term perspective only. But let's say in the short term, I mean, from an investor who is sitting on liquidity, does it make sense to go ahead and invest right away? Or does it make sense to look at investment his money over a period of time?
Sure. So if you really see the way markets have reacted to US Fed rate hike moves, I think things are looking better. I would say worst seem to be over, at least for the near term, and some investments can be done. I would say the 2 events have already been passed. Shiva can add more on the US Fed side, but if you really see 2-year US yield, we have already discounted 5 rate hikes, if I am correct. So what more they will do unless and until inflation just go out of whack. So as of now, things looks better, I would say, in the very short term. However, coming March, you will have US Fed again coming out with the press release and the announcements. Whether they do it 25 bips hike or a 50 bips hike, and also how the taper or the reversal would be, I think will be keenly watched. But as of now, I think things should be better than what it was, let's say, in Jan.
Okay, thank you. Shiva, your views on the interest rates? I mean, anything that you want to speak about in addition to what Jinesh has highlighted?
Yeah, I think a couple of things I would want to highlight. One is that yes, the market has shifted to an expectation of Fed interest rate normalization, and consequently, you have seen rates move up in the US, and in fact, emerging markets across the board, we have seen interest rates globally start to move up. But what's really interesting for me is that inflation expectations globally and in the US have not really risen. Even though the recent past we have seen significantly higher inflation, we have not actually seen inflation expectations rise. It is more that the extraordinarily low interest rates is no longer justified if growth is normal and you therefore want to expect normal interest rates. It's more about normalization than about a rise in inflation expectations. This is somewhat different from what we have seen from in the past. So we have seen in the past, sometimes we've had sharp rise in inflation expectations. In fact, inflation expectations are very stable. In India, I think, so when you look at it from that perspective, it's more about the fact that can we get positive real rates at some stage in global fixed income markets? We've had, since 2009, 2009 financial crisis, we've had, the Fed funds rate or the ECB's refinance rate, etc., at negative real interest rates. So the question really is, can these rates move to positive real interest rates? So fixed income markets finally going to beat inflation? In India too, that's a story. For the last couple of years, we've had inflation at 6% and the RBI's policy rate at 3.35%. Incrementally, inflation is probably going to be around 5% for this year. That's the RBI forecast, maybe a little above 5%. And even today, the policy rate is at 4%. So the question is that, can rates move up above inflation? And this is I think, very fundamental, because all of us keep money in fixed income, and right now we are losing because inflation is higher than the rate we are making on short-term safe assets, whether that's FDs or short-term, mutual funds, etc. I think that is likely to change in the near term as interest rates move up. The first and foremost thing is that we should welcome it, simply from a perspective that we are finally going to get rewarded for keeping cash. And that is started to happen in parts of the bond market. Inflation is at 5, 10-year G-Sec is closer to 7. So already various parts of the fixed income markets already starting to give you positive real rates. And I think that will be the big change, and that's likely to play out in various parts of the world. This is the first and most important thing about investing in bond markets, is to be able to beat inflation. And finally, we are in a position where we can do that. Certainly in India, the rest of the world, perhaps in the next year or two.
Sure. Thanks so much, Shiva. Jinesh, coming back to you, the next obvious question for you is the impact on various sectors. So one, of course, your view on how is the budget likely to impact the banking sector per se. And second is any other sectors which you would typically be bullish on post these announcements.
So banking sector, we remain fairly bullish now, unless there is a COVID fourth wave, and again, there are lockdowns and asset quality stress which comes up. Hopefully, we should not get into those type of scenario. We had a bad last 2 years, especially on the stress asset side, asset quality side. Things are looking really good from financial sector point of view, especially when you see the numbers coming and the stress which has come down significantly as economy has opened up and as economy has gone back to pre-COVID levels. And if you really see 8% real GDP growth would translate hopefully into 10% credit growth, industry credit growth, and some of the banks with lower market share can grow at 1.52x of that industry credit growth. So clearly 15 to 20% growth is what we can see in some of the banks which can come, and with lower asset quality, I think it will be a good money making opportunity for the banks when economy is growing at 8%. So I think, as I said in my opening comment, that 8% GDP growth, real GDP growth, or let's say 12% or maybe 13% nominal GDP growth bodes well from corporate earnings point of view, and banks being a direct link to GDP multiplier should benefit.
Sure. Thanks, Jinesh. Any other sectors other than banking? I mean, anything else that you would want to highlight or talk about?
So I think across the board, if the momentum is strong, and as the unorganized segment or unorganized sectors get further, I would say, lose market share, the listed players across sectors should do well. And we have to go stock by stock in a particular sector, but anything linked to GDP multiplier should do well.
Okay. Shiva, a couple of questions on the bond and the fixed income market. One is, of course, let's say in the budget itself, there is a 6.4% fiscal deficit projection which has come up. We've seen in the past that there have been some slippages in these projections, right? And we could end up with a deficit which is maybe higher than what they have projected, which would lead to increased borrowing from the government's perspective. There is also a view that the the income which the government has projected is slightly on the conservative side, right? Whether it is from the privatization or whether it is even from the dividend income. So how do you look at these numbers? I mean, do you think that they are really conservative and we could see some upside on the income? And your views on the fiscal deficit? Yeah, I mean, anything that you would want to comment on that?
So definitely it looks like the government has under budgeted the potential from tax collections. Forget about the divestment and other income. Basic tax collections are expected to grow less than the growth in GDP, which is unlikely. Typically in a growing economy, you should expect tax collections to rise faster than the underlying growth in GDP, or at least keep up, if not grow faster. So without any change in the tax rates, why should we expect the tax collections to grow at a slower pace? So it does look like they have under budgeted or conservatively estimated income, which is good news in some sense that potentially you could overachieve. That's what we have done in the current year, in 2021-22. Significant outperformance of tax collections relative to earlier budget. But that has not reduced the deficit. Essentially, something else is eating it up, perhaps divestments, perhaps higher expenditure, and so on and so forth. So that's what is likely to happen. Even if there is outperformance on taxes, it's very, very possible that you could end up with the same budget deficit. That is, they will figure out ways to spend that money. On the expenditure side, also there are a few things to keep in mind. Firstly, the headline numbers, and this has been well discussed in the media. The headline numbers around, for example, 30-35% increase in capex, etc. They're part of it is just accounting shifts, and therefore the actual expenditure pickup also is actually not as high as the government has projected. All of this means that this budget is definitely not an ambitious budget, either in terms of expenditures or in terms of income, and therefore meeting the budget targets should be significantly easier. And of course, if you have a big IPO like LIC, it looks like LIC has been taken off the table, at least a large divestment in LIC has been taken off the table for both this year and next year. Even if they go for it now, it looks like it might be in piecemeal or in smaller chunks. So there's potential for some upside there, etc. So I think achievable numbers, which is good news. We don't have to worry about slippages. But I would not be optimistic on the other side. So do not expect that the government will magically consolidate. You have had extraordinarily good tax collections this year and they did not consolidate. I don't expect there to be this kind of buoyancy next year, but even with some upside on taxes and other revenue, we should expect the fiscal deficit to be maintained. What is also of a bit of concern is that apart from a general statement that they would want to bring the deficit down to 4.5% by financial year 26, it's quite some time away, we still don't have a good path for fiscal consolidation in the years ahead. So in that sense, from this budget perspective and for the next few years, we should expect a relatively elevated deficit. So yeah, I think fiscal deficit is likely to remain somewhat of a concern for the next 1 or 2 years.
Sure. Thanks, Shiva. In light of what you just highlighted, from an investor perspective, how should they really look at fixed income investments now? I mean, two aspects. One is, of course, the yields have gone up over the last few months, including the move up that we saw yesterday. And at the same time, we would see some reduction from a taxation perspective, as Vishal earlier highlighted, due to the reduction in surcharge. So, I mean, both of these would automatically mean that the accrual yields for the investors in fixed income will probably go up compared to what we've seen in this year. But at the same time, there is also the risk of further increase in the yields in the market, right? Which would have a negative impact on the returns. So how should investors really look at playing the fixed income investments in their portfolio?
Now, this is very important because first and foremost, as I mentioned, the first part is, can you find assets which can actually protect against inflation? And right now, the answer is yes. Expected inflation in the near term is likely to be about 5%. And it's possible that in the next few years, inflation should hover maybe between 4 and 5%. The RBI is clearly targeting a 4% inflation rate, but well, they've not been very successful at least for the last 2 years, and unlikely to be so in the next year and a half as well. So let's assume 5% inflation for the next few years. What assets can definitely give us significantly above 5%? And today, the good news is a lot of assets are. If you look at even a short-term floating rate bond, that's about 5.5%. When you look at 5-year government bonds, they can be at 6%. And if you look at 5-year corporate bonds, you're looking at well above 6%. If you look at 10 years, we're looking at corporate bonds, and I'm talking about AAA corporate bonds and government securities in the range of 7.25. So various parts of the yield curve today are going to at least compensate you and compensate you well against inflation. And that's the first most important thing. Short-term AA and single A corporate bonds are in the range of between 6 to 8%. Again, well above the inflation rate, and more importantly, protected against rising interest rates because the duration risk is quite low. So I think across the board, we now actually have decent investment opportunities. And while we are worried about fiscal deficits, I think the implication in terms of how high yields can go. I mean, for example, we are already at close to 7% on the government bond yield. Can the 7 go to 8? I would say with what we have and what we can project, that risk is quite low. If inflation is expected to average about 5%, then 7% or plus minus a little bit is where you expect the 10-year to be. I mean, effectively 2% real rate of return in the long term. So I think a lot of the pain and pressure in terms of rising interest rates, especially for long-term bonds, is done. Short-term bonds is a different story. As against inflation of 5%, 1-year yields are actually just under 5%. So there is still a significant upside to yields and interest rates at the short end. And that's not bad news, actually, because there is very little duration. So if you buy a short-term fund, the so-called reinvestment, that is, let's say if you have a 3-year investment horizon and you buy a 1.5-year duration fund, effectively your entire portfolio is going to get churned over at 1 to 2 times over your investment horizon. And if you have interest rates going up, your mark-to-market impact will be limited because assets are getting matured and actually getting reinvested at higher rates. So 2 parts of the curve. One is your long-term securities, which you should hold in the form of so-called roll-down strategies. Please speak to your Axis Bank representative. They'll be able to help you with identifying such products. And second, at the shorter end, floating rate, money market assets, which will benefit from rising rates. I think these are the 2 strong pockets from an interest rate perspective. And lastly, like I said, please do look at credits, the non-AAA space. It's very, very, it's not an easy task to get into that space, especially given the history post-ILFS. But ILFS is 3.5 years ago. And all the distress which was to happen happened in 2018 and 19. Post-pandemic, in fact, credits have significantly outperformed. And if that were to be the case, that's one more pocket where both yields are attractive and we are actually seeing outperformance. Because while you're seeing rises in yields in G-Secs and AAA bonds, we've actually not seen that kind of stress in non-AAA space. So you're both benefiting from a higher yield, but also from less mark-to-market impact. So I think there are really interesting opportunities right now. Like I said, please speak to who your banker, and they'll be able to guide you.
Sure. Thanks so much, Shiva. Vishal, couple of questions for you. I mean, coming back to you. One is, of course, in the budget, there have been a couple of announcements on the virtual currency and the fact that RBI is planning to launch its own digital currency. Have they really spelled out any details in terms of how, when, or any other details around when that would happen?
I think the how is probably not spelled out. The when is. It seems it's probably sometime in 22-23 financial is when I think that announcement is likely to be made on the central bank digital currency of the RBI. But in what shape and form, etc., I think those details are still awaited.
Sure. And the fact that any income or gains from virtual currencies is now taxed, does that mean that they have granted legal status to this sort of an asset class?
I think they've granted taxable status to the asset class. Whether it is legal or otherwise is still out there. I think one will need to wait for the much talked about regulations around this, probably the crypto bill, etc., which will shed light on these aspects as to what is legal, what is not, and all of that. But I would certainly say that the investor segment tends to believe that because it is taxable, it is legal. I don't think that could be entirely correct, but from my standpoint, from my viewpoint, I'd say it's certainly taxable. The rest of the answer is we'll know when
Still
the
open for.
out. Yeah.
Sure. Vishal, one more. I mean, if it's not directly linked to the discussion that we're having, but since there are multiple such questions which have come from different participants, given the fact that there have been no direct changes in the taxation or in terms of enhancement in limits of the various tax saving instruments, I mean, your quick thoughts in terms of the different options which are available to investors today to try and reduce taxation from their from the income that they receive. I mean, maybe just a quick overview. I know it's a long discussion point itself, but maybe, I mean, if you can just list out some 4 or 5 assets and how they can look at it.
Yeah, I would think not to be taken as investment advice, because I'm not an investment advisor or a professional in that sense, but just purely from a tax perspective for an individual salaried class type profile, I would think 80C remains to be one of the key tax saving options available. So the regular LICs, PPF, the insurance premium and that segment that is covered under Section 80C of 1,50,000 is a key one. I think the other option that's available, and it depends on whether the employer sets it up and exercises that option, is probably the National Pension Scheme. And that's something that can be looked at to provide additional advantage over and above the 1,50,000 that's available under 80C today. So just some short thoughts.
Sure, I understand. I mean, this itself is a huge topic for discussion, but thanks for just giving a quick overview. There are various questions on stock-specific questions. I mean, views on Yes Bank, IRCTC, Vodafone, and all of those. And I'm sure, Jinesh, you will have compliance issues on taking them up. So I'm not really going to pose those questions to you, and do apologies to all the participants who have actually asked for stock-specific views. But one question which possibly either you, Jinesh, or Shiva could take up is in the huge capex outlay which is there in the budget. How do you look at it, and what are the pros and cons of such a huge capex outlay?
So if it's okay, I'll do the sort of macro and top down, and I think I'll leave it to Jinesh to give a sector specific view. So first of all, I think the number, while it looks huge, like 30-35% increase that the finance minister talked about, the reality is some of it is just reclassification, and therefore the total expenditure is likely to go up only about 12 or 15%. So it's not a small increase, but definitely not the headline increase that's being talked about. The good news in some sense is that there's an increase in allocation to states. I think state governments in India are better at spending money than the center. The center's ability to spend money is limited to a few sectors where they have a large outsized presence. Many of the infrastructure sectors are already privatized or have private means of raising money. Roads, for example, are bid through projects. Power, many of the big sectors where the government may have historically invested are being bid through projects, etc. So in that sense, the ability for the center to spend money on some of these projects are actually getting quite limited. So giving a lot of that money to the states, in my estimate, will actually lead to better utilization of that money and the ability to utilize, not just whether it can be whether it makes sense or not, but actually just the ability to spend. Historically, the capex budget is one of the places where you actually don't spend as much as initially budgeted. In some ways, it's looked at as a kind of a saving. That is to say, when there's a shortfall elsewhere in the budget, you cut the capex and save the money. But here we are in a situation where the government may actually want to spend, and it's easier to hand that money over to the states, who may actually be closer to the ground in terms of project implementation. So my sense is, first, don't get too excited by the headline number. A lot of that is reclassification, but there is going to be an additional spending. And the way they're spending, especially by handing money to the states, is a welcome positive. Jinesh, you want to sort of take it from there a bit?
Yeah, so I think Shiva has rightly said that it is more of a continuation of the growth momentum at 10 to 12% of capex spend. And the good part is now they want to devolve 1 lakh crores of that to the state. And because many projects, when they come on ground, land is a state subject. So clearly it becomes very difficult for the central government to execute the project unless and until state gives the go ahead. So I think that is a good move. I would say it is not a capex bazooka or capex festival kind of a I would say an announcement which has come. But the good part is the transparency. I think many off balance sheet have been brought on balance sheet, which is a good sign, I would say, on a longer term basis.
Sure. Thanks so much. To the end of the 1 hour that the time that we budgeted for the seminar today. But maybe we can just take up one last question, Vishal, which again is for you. I mean, while we've covered some of the individual categories and you highlighted, so there's nothing much from a taxation perspective for them. There is a question which has come from a business owner perspective, the MSME segment, saying that clearly there seems to be some unhappiness on the fact that there is nothing in it for them, especially after the 2 years of pain that they have gone through. So anything that you could highlight, is there anything in the budget for the MSME segment, or how should they look at this budget?
I would think the one thing that immediately comes to mind on this is the extension of the tax benefit for manufacturing setups, right? So if you're starting a new entity which gets into manufacturing, there is some benefit that has been offered there, and that's, I think, directly in one sense related to MSME segment. But yeah, I think other than that, I can't think of anything specifically for that segment. There are a lot of announcements on the other corporate issues. Some of these relate to, like I said earlier, probably procedural matters, but I don't think there are any big ticket announcements for the MSME segments, at least from an income tax side.
Sure. Thanks so much. Jinesh, one last question which has come after in the last few seconds is the 50-year interest-free loan to states. How is this likely to impact the equity markets?
I don't think equity markets would have anything to do with it. I think Shiva would be in a better position to give answer, but I don't think it is anything significantly positive or negative for equity markets. Shiva?
No, I agree. I think this is just about, instead of giving it as a grant to states, they're just doing it as a loan. It's just a way for them to manage it instead of, like I said, instead of giving it as a revenue or a capex grant, structure it as a loan, but the cash flow impact is the same amount of money goes.
Sure. Thank you so much. Once again, thanks Vishal, Jinesh, Shiva for taking time out to spend time with all our customers and the investors on the call today. And thank you once again to all the participants who've taken time out to join us. Hopefully, all the discussions that we've done today and the questions and the responses given by the experts has helped decode and understand the budget a little better. Of course, we do hope that the equity markets, the fixed income markets continue to do as well as they've done over the last few years. And we have, as our Honorable Finance Minister called it, the Amrit Kal, which is the next 25 years, will be once again the golden period for India. So thank you once again, and I look forward to the next time we meet again. Thank you.
Thank you. Bye, guys. Stay safe.
Thank you, everyone. Thanks for your time.